The next concept also used for trade entries is the fair value gap, often shortened and spelled as FVG. The fair value gap is a concept that explains that large sharp movements makes the market inefficient. The theory is similar to the supply and demand zones, mostly because both breaks the market's price and make it unfair for one side of participants, buyers or sellers. And in the case of the fair value gap, it is the level where the market becomes inefficient. And it is used for trade entry strategies, because once price comes back to fill the inefficiency, you will often see a reaction on these levels. It is important to know that the fair value gap is met more rarely than the supply and demand. Let's look at a downtrend line chart before using the candlestick chart, because it makes it easier to understand. As we know, in an uptrend, the price creates higher high and higher lows. On uptrends, we look for demand zones for the pullback to hit the demand zones and potentially give traders opportunities for buying positions. But the pullback doesn't always just hit the demand zone. Considering the price keeps holding the uptrend, this is where the fair value gap comes in, where the price is pulled back, filled the fair value gap, and continued the uptrend. The traders that have waited for the demand zone to hit have lost the opportunity, while the ones that took from the fair value gap successfully capitalized on this setup. We will soon explain in what situations you can analyze to determine if you would look for the fair value gap or look for the demand zone. But for now, let's also explain it from the downtrend. On a downtrend, the price goes down, pulls back to the upside. Situation where there might be formed supply zones to take the price down and basically continue the downtrend. But the pullback might also end lower than anticipated. And that might be because of a formed fair value gap that filled the inefficiency before hitting the supply zone. And the filling of the inefficiency on a downtrend validates the continuation of the initial macro trend, which is a downtrend. Now we want to identify the fair value gap using candles, and then we jump into the charts. First, we will present it for the uptrend. We want to look at a sequence of 3 candles, where one of them has pushed very aggressively, with a higher momentum than the previous ones. The previous candle should have its high wick lower than the entire body of the large candle. And the third candle, which is the next candle from the larger one, should have the lower wick higher than the whole body of the large candle. Notice how if we mark with a line the high wick of the first candle, with the low wick of the third candle, we get a zone. This is the fair value gap in an uptrend scenario. Notice the inefficiency created. And this area can be used as an entry strategy once price comes back down to fill the zone. And now for the downtrend scenario, the rules are similar. We want to look for a sequence of candles, usually 3 or 4. There must be a large candle with a larger momentum than the previous ones. The candle previous to the larger one should have its lower wick higher than the whole large candle. And the candle next to the large one must have its higher wick lower than the whole body of the large candle. And we take a line or any instrument to mark the low wick from the first candle and the high wick from the third candle. And this is the bearish fair value gap that can give traders an opportunity for sell short orders once price fills the inefficiency. This is the US dollar against the Japanese yen in the 2-hour time frame. From the left of the chart, the market has been in a short-lived uptrend, with only one bullish break of structure before price breaking the swing lows, and essentially changing character into a bearish structure. The change of character validates the presence of the follow bearish fair value gap. This is the first candle. The second candle is the large candle, and the one next to the large one is the third candle. There's a noticeable small price inefficiency, and we mark the zone as we have learned. Keep in mind, we look for the formations of fair value gaps as soon as we can identify them. But we take them into consideration only if the trend or market structure validates the fair value gap. So we should be able to identify the fair value gap soon after it printed on the chart. But in this market structure, the validation comes only after we have a trend change. Because if we are right here, the bearish gap has appeared, but the market is still bullish. For the gap to be the highest quality, we wait for the structure to change character into the same trend that the fair value gap was printed, so into a bearish trend in this case, and we simply wait for the price to fill the inefficiency, then take a sell short position, with the stop loss above the last swing high, and take profit below the last swing low. These targets make sense because on downtrends we do not expect the price to make higher highs. Instead, we expect the market to make lower highs. This was the explanation for the positioning of the stop loss, and for the take profit. On a downtrend, we do not expect the market to make higher lows. Instead, we expect the market to make lower lows. So a break of the last lows. A break of the lows is itself a bearish break of structure. What happens after a push to the downside in a downtrend? A pullback to the upside, and then continuation of the bearish trend by breaking the lows. Then the market gains bullish momentum, and we notice the formation of a bullish fair value gap. This is the first candle, the second candle is the large one, and the third candle is the next one from the larger one. And this zone is the bullish fair value gap. But the problem here is that the market has not validates this fair value gap, because the market was still in a downtrend when the gap has appeared. The bullish change of character. So the trend change from a downtrend into an uptrend has happened after the gap has already filled. So this is a lower quality fair value gap, that in this situation it has worked. We signaled it as a counter trend. Fair value gap, trading against the trend is really difficult. We did not take this trade. Even if the setup has worked, there are countless more opportunities to take in the future. Be responsible and avoid taking unwanted risks. Alright, but after we get another large bullish fair value gap, this one is the first candle. The large candle is very visible. And the third candle, what we expect is for the market to come back down, move around this zone, and reverse to the upside, essentially continuing the recently created uptrend by breaking higher highs. Now I have some tips for you. Since this zone is very large, what we can do is to wait for the price to come back down. Switch to a lower time frame. Look for a bullish change of character, and a formation of a demand zone or a fair value gap inside the lower time frame. Look for buy order opportunities, and follow the price action to take profits on the break of the higher highs. If you noticed, we usually use the higher time frames more often. This one is the Nasdaq futures in the 5-minute time frames. This one is a lower time frame chart, and the reason we do not use lower time frames very often is because of false signals and low quality structures. For example, look at this. These are all fair value gaps. The first one from the lowest point didn't got filled. The second one from above got broken down. The third one also didn't got filled. It's only the fourth fair value gap that got respected. This is the first candle. The second candle is the large one. The third one is the candle next to the large one. And by marking the zones, we see price filled the inefficiency with a wick and reversed to the upside. So this was a valid fair value gap. And even the next one from the above. So the fifth fair value gap did not fill. From 5 fair value gaps, we got only 1 that has worked, 1 that has failed, and 3 that did not fill. And price just continued pushing to the upside. I'm not saying that low time frames inefficiencies do not work. They can work, but they are much harder to analyze and need complex knowledge to filter them out and increase your chances of success as much as possible. But why complicate it so much when you can just have more patience? Switch to a higher time frame and do the analysis there. To give a perspective on using low time frame fair value gaps, we will trade a couple of examples during a backtest. So the market is in a downtrend. The wicks fill all inefficiencies, so basically there is no significant bearish fair value gap present to trade. But there is a bullish fair value gap. Now that is this very risky to take because we are taking buys into a downtrend. Basically, we are trading against the trend. Of course, the trend can reverse, but trying to predict the reversal is very difficult. But since this is a backtest, we will take a buy if the inefficiency gets filled. So we are placing a buy order on the top of the gap. The stop loss below the lows, the take profit above the highs. And this is about a 1 to 2 risk to reward. Not the worst, but not the best. So let's see what the price does. The position was opened, and the trade was a 1. Let's see the continuation of the price action. And by the way, we got a bullish change of character since the market has broken the last high, and we got the pullback, and the break of the highs. So essentially, we are in an uptrend now. There is another fair value gap. Buy orders at the top, stop loss below the lows, And sadly, we do not have really good take-profit targets, this being a lower risk to reward trade. I will expand the position to at least a 1 to 2 and leave this position for longer. Now there's another fair value gap. Stop loss below the lows, take profit to at least 1 to 2 risk to reward. Let's see if we can get a 1 to 3. We can also place the stop loss below the fair value gap. That could give us a higher risk to reward, but it can come with more stop losses being hit. Keep in mind the past position is still running, so we are in 2 buys at the same time. And both positions hit, take profit. The difference between time frames is quality and hit rate. In low time frames, just as we have traded recently, the hit rate is high, the quality is low, and the risk to reward is low. In high time frames, the hit rate is low, the quality is high, and the risk to reward is high. So in the high time frame, we would need only 1 or 2 high quality setups to gain the same total risk to reward ratio as we would in a low time frame. The last one was a low time frame. Now it's time to also look into a setup on a high time frame to give as example backtesting. So this market is clearly bearish. Looks like it initially was in an uptrend and failed to keep the bullish momentum, making sellers gaining control and taking over this market. Before looking for setups, we need to analyze the market. Right here, for example, we got an ascending trend line with liquidity resting below that, shortly after got taken by breaking the trend line to the downside. The downtrend is easily identified by the bearish breaks of structure. We got one right here, then another one, another break of structure, and one more. So far, the market is pushed to the downside in a very aggressive manner, right until the last visible price action where it looks like bearish momentum is decreasing. The lower wicks also signal a liquidation of orders. The price action so far looks like smart money is preparing something. We are not taking any positions yet as there is no significant confirmation or any kind of relevant enough detail for a setup. So let's play the price action and wait until we can spot an opportunity. Finally, the time for some upside movement. This is a very aggressive upside movement. We should have fair value gaps. But first, make sure to mark the bullish change of character, so we do not forget that the market might reverse into an uptrend. This change of character also validates the presence of a fair value gap. The fair value gap is not this, because we can clearly see the lower wick of the large candle almost covers the body of the previous candle, making the price efficient enough to not be taken into consideration. The actual fair value gap is found here. I will write the zone to make sure we do not get lost in between lines. And we place a buy order on the top of the fair value gap. For the stop loss, we have multiple options, like placing the stop loss below the lows, or placing it below the gap, since this is a higher time frame, and the setup quality should be higher. I will place the stop loss below the zone, and we will also have a higher risk to reward ratio, looking for at least a 1 to 3 risk to reward. Good. The position got filled, and notice the immediate reaction to the upside. We are looking for the price to break the highs. So essentially, we want the market to create a bullish break of structure, since the market has changed character from a bearish standpoint into a bullish one. The trade has hit the take profit, but let's just look if it actually managed to break the highs. And yes, it did.